Consideration of laws, rules, regulations in an audit of the financial statements. Well, this is the standard on audit, mainly for the auditor's responsibilities to consider the laws and regulations in the audit of the financial statements. It is not applicable to other assurance engagement where the auditor is specifically required to report on, if any, on the non-compliance with the specific laws, rules, regulations. According to this, the non-compliance is an act of omission or commission by the entity, other intentional or unintentional, which are contrary to the prevailing laws or regulations. Audit is objective over the laws, rules, regulations. The objective of the auditor is to perform a specific audit procedures to identify the instances of non-compliance which have a direct impact on the financial statements, to obtain a sufficient appropriate audit evidence regarding the laws and regulations which have a direct impact on the financial statements. The auditor has to perform a specific audit procedures in respect of this. Auditor has to respond appropriately if any non-compliance is being observed, and to respond appropriately to non-compliance if any suspected non-compliance with such laws, rules, regulations during the course of the audit. Impact on the financial statements. The provisions of laws and regulations may have either a direct or indirect impact on the reported amounts and the disclosures in the financial statements. Non-compliance may result in fines, penalties, litigations, or other consequences for the entity that may have a material impact on the financial statements. Moving to the responsibilities for the compliance with the regulations, rules, it is responsibility of the management and those charged with the corporate governance to ensure that the entity's operations are conducted in accordance with such laws. Auditor's responsibility. Auditor is responsible for identifying material misstatement in the financial statements due to non-compliance. However, auditor is not responsible for preventing such non-compliance and is not expected to detect non-compliance relating to all laws, regulations. Auditor is expected to obtain a reasonable assurance that on the financial statement as a whole are free from material misstatements, whether caused due to fraud or error. The standard distinguishes the two. First, with those impacts which have directly on the financial statements. Here the auditor is expected to obtain a sufficient appropriate evidence with respect to the such non-compliance. Second, if there is no impact on the financial statements, however there is an consequences on its operations, business, and in order if it will have a legal consequences or imposition of penalties, then the auditor is responsible to limited to understanding the operations and is expected to specify audit procedures to help identify such non-compliance with such laws, regulations that may have a direct impact on the financial statements. Auditor's consideration for compliance with relevant laws and regulations. Auditor shall obtain a general understanding of the following: legal environment, regulatory framework, applicability of the entities, laws, rules, sectors in which they operate, entity compliance with the relevant framework. Auditor shall obtain a sufficient appropriate audit evidence regarding compliance with laws, regulations. recognized to have a direct impact and determination of material amount and disclosures in the financial statements. Auditors shall perform the following audit procedures to identify the instances of the non-compliance, such as inquiry, inspection, correspondence of the relevant licensing, regulations, regulatory authorities' decisions, and maintain a professional skepticism throughout the audit. Also, obtain an audit representation as per the standard from the management, stating that all the instances of non-compliance or suspected non-compliance with such laws and regulations have been disclosed in the audit. Audit procedures to perform when non-compliance is identified or suspected, such as compliance with the acts, nature of effect on the financial statements. An auditor is required to have an awareness of the information concerning an instances of non-compliance or suspects a non-compliance with the auditors need to obtain. Understanding on the relevant acts, circumstances under which it occurs. Further information to evaluate the possible effect on the financial statement. If the auditor suspects that there may or have compliance which are the auditor shall discuss the matter with the management, those charged with corporate governance, and obtain external circumstances through confirmation. In such cases, the auditor shall obtain a sufficient appropriate audit evidence relating to the non-compliance. The auditor shall evaluate the lack of sufficient appropriate audit evidence on the auditor's opinion, so that if there is a non-compliance, the auditor shall report it. Auditor shall report on the non-compliance to those charged with corporate governance. Unless all those TCWG are involved in the management of the entity and are not aware of the matters involving identified or suspected non-compliance already communicated by the auditor, the auditor shall communicate with those charged with corporate governance relating to the non-compliance that comes under auditor's attention during the course of audit, other than that matters that are clearly inconsequential. The auditor's judgment. The non-compliance is behaved and is sometimes believed that the intention and material. The auditor shall in such cases communicate the matter to those charged with corporate governance as soon as they are observed. If the auditor suspects that the management or those charged with corporate governance are involved in the non-compliance, the auditor shall communicate the matters to the next level, which is sometimes your audit committee, and or sometimes in some countries there might be, in some organization there might be some supervisory board. Where no such higher authority like audit committee or supervisory board exists, or the auditor believes that the communication may be acted upon or is unsure that it will be acted, and the person with whom to report, the auditor shall consider the need to obtain a legal advice. Moving to auditors reporting our non-compliance. If the auditor concludes that the non-compliance has a material effect on the financial statements and has not been adequately reflected in the financial statements, the auditor shall in such cases modify the audit opinion in the independent auditor's report and express a qualified or adverse opinion on the financial statements. If the auditor is unable to obtain a sufficient and appropriate audit evidence, the auditor should evaluate whether the non-compliance have a material effect on the financial statements or is likely to have occur. The auditor shall express a qualified opinion or disclaimer an opinion on the financial statements on the basis of limitations of the scope of the audit in accordance with such standard. If the auditor is unable to determine whether non-compliance has occurred because of limitations imposed by the circumstances rather than by management or those charged with corporate governance, the auditor shall sometimes evaluate the effect of the auditor's opinion. If the auditor has identified a suspected non-compliance with laws regulations, the auditor shall determine whether the auditor has a responsibility to report of such identified suspected non-compliance to parties outside the entities. Moving to the documentation, the auditor shall identify and document all these opinions, all the information which they have gathered about the non-compliance, and they should make it available to the management or those charged with corporate governance or to the regulatory authorities of such non-compliance, and shall also identify any suspected non-compliance and document it for audit evidence and for future references. So this is all about the future audit actions if the matters relating to non-compliance of rules, regulations,